Good day, fellow investors. Last week we did this Brookfield risk and reward analysis where the reward, yes, is there 16% per year as the value grows. Moderate risk that we also discussed a little bit more, emphasized that moderate, where if the market turns, then there is a big risk of loss. And that is the risk and reward. I don't agree with their acquisitions of renewable at whatever price, but I got this email and there were many comments here from Alan how he owned Brookfield for years now and he's getting nervous because it became a huge percentage of the portfolio and he now wants to do a full review because of the risks that I emphasized. Oh, by the way, as the comments here on YouTube are crazy, you can always send me an email for questions at investwithsven@gmail.com. And what I wanted to discuss, because it was a funny video there on the risk and reward, is that nobody knows what will happen. If the environment doesn't change, Brookfield reward 2x, 3x easy over the next 3-4 years. And I'm not joking here. If the environment doesn't change. If the environment changes, there is risk. That is something that nobody can predict. You can bet on it and then it turns into what kind of bet this is. On the reward side, yes, as I said, no problem, 2x in 4-5 years if this just keeps going on. However, if the environment changes, there is the risk of permanent capital loss, and if we look back just a year, there is also the risk of minus 50%. Everything is possible because we cannot know how will the world look like in a year. But if you put that into a bet perspective, what are the chances of 120, 30 or 0 in 3 years? Well, if we put 40%, 40 and 10, if I calculate, then let's say the value of Brookfield is at 60. Compare it to the current stock price and we are there, let's say, fairly valued. But I can also change the valuations, the percentages here, 80, 15, 5, and then the value of the stock is 100. And now it is up to you to see what kind of scenarios, what are the chances of those scenarios happening, and then structurally creating a betting portfolio on that with 10, 20 such bets, uncorrelated bets, because if you bet all on one side and it happens like you're betting low interest rates for Brookfield is positive and you bet all the portfolio on low interest rates and then interest rates are higher, then you lose everything. You lose all your portfolio and that's it, you're gone. So Brookfield can be a bet and then into a portfolio, and that's something different than what we do here on the channel, which is value investing. And when it comes to value investing, we want to avoid permanent capital loss. We want to avoid that mistakes of making. And plus, it's up 2x over the last year. Charlie Munger, as a value investing perspective, uses to say that you don't have to squeeze every dollar out of a trade. Leave also some room from others. If you look at the stock price here and now at 60, this is a huge difference also from that risk and reward betting perspective. Now the risk is twice what it was here and the reward is 0.5 of what it was here, just because the stock price went up. So that's also something to take into consideration. Value investing is, okay, looking at the business, looking at the fundamentals and assessing whether we can lose everything. If we can lose everything, that's not in a prudent investing concept and you just tuck it away to hard pile for somebody else. And there were many comments how Blackstone, Brookfield doomed, Howard Marks, Bill Ackman is investing there. And yes, I don't know what those guys are investing for, why are they investing. I don't know how this, at this moment in time, fits their strategy. That's the key. And you have to understand how this fits your strategy. This is again value investing. We look at the risks and we say, okay, not from a value investing perspective at this moment, not even a bet, not even from a value investing betting portfolio, not even a long-term investment. At a different price, maybe a bet. And there were also some comments, no renewables, again, because I analyzed also the risks of PayPal a year ago, too risky at that moment in time. But we will miss another opportunity. Yes, we will miss hundreds of opportunities of stocks that are too risky going up. That's the nature of value investing. We miss on huge losses, marijuana stocks we didn't invest, etc. We didn't invest with Cathie Wood. Okay, that is something that we will happily continue to miss. And then yes, I will miss the Teslas and look like an idiot, the Bitcoins. But that's the essence of value investing. I'm still here, I'm still investing, while many others are not. And the key when it comes to investing, it is impossible to know the future. The key with value investing is that whatever happens, I am okay. With Brookfield, that isn't the case, on top of something else. I don't know. Maybe there will be high inflation in the next 5 years as we discussed, maybe not. The market is most likely in a bubble, the bubble can continue, the bubble might crash. I don't know what will happen in the future. The key answer you must find for yourself is how do you want to build your wealth? I don't want to build my wealth by buying renewables at 3 times the value. For example, Brookfield just bought Neoen for $6 billion, and this is what they're buying. Let me be again a little bit sarcastic just for the fun. They say that Brookfield is managing and improving the management of the company, acquiring. I don't know what's going to happen here. If the CEO of Brookfield is going to shear that sheep there and take the wool and sell it personally, then I'm going to buy Brookfield. But apart from that joke, if we look at the balance sheet, yes, they have 8 billion of assets, but if we deduct the liabilities that they took to build those assets, total equity is 2.7 billion. There is some reserves. I don't know if that is the revaluation reserves. So 2 billion, they paid 6 billion. Okay, let's say even for 3 billion of assets. They paid 2x on renewables. Go back to the value. This is tangible assets. There cannot be other benefits there than this. And therefore, I'm not thinking this is something that builds wealth if you pay 2-3 times the value. And sooner or later, all these financial engineering schemes, because if you take debt of 6 billion to buy something that's worth 2 billion, that's already levered, that's financial engineering, and sooner or later, those stories come to an end. That story can end in 2050. I don't know when. It's just a risk I'm not willing to take. And I'm happy to be on the 3% of investors not taking those risks. And if the rest of 97% of investors on YouTube, whatever, want to take those risks, that's their story. If you are on the 3%, subscribe, and I'll see you in the next video.